Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. Hope you're well. Tuning in across the Property Investment Podcast Network and also on the marvels of the interweb, probably on the YouTube and other places where they host video these days. People like to see people talking on podcasts now as video, and that's just the way of the world. So we're doing a lot more of it through demand. People have asked for it. We'll definitely do it. And you can see on my blank sheet of paper here, I've just got written one little bit at the top of it, which is pretty much going to be today's topic. And this way we like to do it, pretty organic. Though who knows what we're going to talk about. But this gentleman who's joining me in the studio is number one in 2022 on the most listened to podcast on the Smart Property Investment Show or the Property Investment Podcast Network, Sam Gordon from Property Scout. For some reason, you, the audience, thought that this was the most interesting podcast we did in 2022. So I'm going to get an update of it for 2023, see where he's going, see what he's up to. And the most popular podcast, it was titled 31 by 31. So 31 properties by 31 years old, which most people think is pretty good going for someone so young. But it sounds as though, I'm told, that definitely not stopping there. And Sam Gordon, as you know, he's been on the show for many years, and he changed from his day job into becoming a buyer's agent a few years ago through Property Scout, and he seems to be doing pretty well. He's all over the show. He's only just moved up, I think, to the Gold Coast, so he's a Queenslander these days. I won't hold that against him. But Sam Gordon, how you going?
Phil, mate, I'm very, very well, mate. Thanks for having us back on.
That's right. Who'd you fly down with from Brisbane today?
Mate, I flew Virgin.
Oh, did you?
I've got to stop flying Virgin. They're the tiger these days. They're unreliable.
Yeah, you were late, weren't you?
I was late. I apologise, mate.
What time were you supposed to be in?
I think I was supposed to be in about 9:30, I think it was. Because I lose an hour heading back across the border.
Yeah, that's true.
But yeah, I didn't get in till, I think it was about 10:30 or whatever. So it's...
So was it late leaving?
Late leaving.
Okay.
Yeah.
But you would have been at the front of the plane with your feet up, sipping champagne, no doubt.
Yeah, mate, the sun was still out up there.
Yeah.
It wasn't down here, so I was out on the tarmac, mate, shirt off. Not really.
That's cool. How's Queensland? How are you finding it?
It's good, mate. It's good. It's great. It's the weather is the main reason I kind of moved up there, and it's certainly delivering. So I'm loving it from a lifestyle perspective, mate. It's good.
Yeah. Okay. So so you bounce around a bit now. You're up there. That's home. You're Queenslander for forever now. You think that's you? You never know.
Yeah.
Who knows?
I've been up there for about 18 months now. So, New South Welshman for 31 years of my life.
That's
and
okay.
yeah, mate, so up there now. I don't know. I love it, mate. I'm not sure, the full long term, but definitely for the foreseeable future.
Who's your footy team?
I don't follow footy, mate. Liverpool in England.
There you go. You're a soccer player by
That's it, mate.
Yeah,
That's
you are,
it.
Back in the day. That's right. Most people get a bit passionate about football.
They do, mate. They do.
There. But is more investors up in Queensland than New South Wales?
Oh, no, bulk of our guys are kind of New South Wales and like Sydney and Melbourne. That might just be because of the population base. So there is still a huge amount that we have from Queensland too.
Yeah.
But we find probably a good 50-60% of the business as a whole would be Sydney and Melbourne at least.
Coming up in buying up there, or
yeah, buying up there, buying everywhere really.
Has it given you a different lens? Because I can't remember how sort of New South Wales centric you were beforehand, but I know you've been buying up in Brizzy or southeast Queensland for many years. Has it sort of helped with permanent boots on the ground for you up there? Has it sort of been an enabler? You can get out a lot more into the suburbs of Brisbane and the Gold Coast and the Sunshine Coast?
A little bit, probably not so much. So last year we bought quite heavily in 2019, 20 and 21 in southeast Queensland, but then 2022 was kind of not the year to buy there. So the whole year, the whole first year I was there, we didn't even do that much there anyway. So unless a real stonker deal came up, but not so much, mate. But I'm always scouting around, mate. I'm always on the plane. I'm normally on the road 1-2 weeks of a month anyway, in on location, because I just love being in on location anywhere. So
tell me where you've been flying to then.
Yeah, just around the country, around Australia.
Here we go. Around the country, around
Property
Australia.
Scout, yeah, just
give me some airports where you've been landing.
Gold Coast.
Yeah.
Sydney.
Yeah. Non-capital cities.
Non-capital cities. Oh, I like to drive, mate. I like to drive.
Okay. So you're going to give me nothing?
Perth's a nice airport.
Yeah. Okay.
Yeah, Perth's a nice airport.
Yeah, I see Melbourne just got rated one of the top 10 airports of the world. I don't know
really?
How. Yeah,
I don't know.
Pretty antiquated. But, they're redoing a domestic You seen a new Qantas domestic terminal there? No, you don't.
Down there? No.
Yeah, no.
I don't fly Qantas, mate.
No.
I'm still a tight ass.
No. Oh.
and
does Virgin actually have the routes that you want into regional areas of Australia on direct flights?
I go Pelican.
You got
Pelican
Air.
Airways.
So you're at Pelican Air.
Pelican Air, mate, all over it. I got shares in
I
that.
know where Pelican flies.
Oh, do you?
And Link, yeah, two
you go.
regional airways to get you out into.
Mate, what are we on this podcast for? Stop trying to pull my areas, mate.
I know. You like regional Australia, right?
I like regional Australia. It's good. It's good.
Which parts
of Australia? It's definitely, mate. It's shaping up really well. It's there's a lot of really good sub-markets out there at the moment. We witnessed it a lot in Sydney and Melbourne, like when they both had their massive booms in 2013 and 2017. You saw a lot of ripple effect kind of go off on and about it because people get priced out of the capital cities, so they kind of move to where they can still get really good employment. And a lot of the time they can still get really high paying jobs, but they're not in the expensive part of the cities, and a lot of the time the lifestyle's better as well. COVID really helped boost that as well. But it's really interesting to watch those markets that weren't given a huge shot in the arm by COVID. A lot of those, there's these other markets that are really coming to the fore now that weren't boosted by that are now super affordable, and a lot of projects and whatnot coming in. So It's good, man. There's a lot going on.
So I've got some yes or no questions for you.
Oh, God, here we go.
It easy for
written
you.
down your sheet.
No,
it's a bare sheet. Yeah, go on.
You're buying in more regional areas than capital city areas?
No. It's a mix.
Give me a percentage.
50-50.
50-50, of course. 50-50. Yes or no, you have your own podcast now?
I do. Yes, I do.
Is it going well? Yes or no?
Yes, it is. Scouting Australia podcast, mate. It's good.
Scouting Australia.
Scouting Australia. Yeah.
How's it differ this? You probably talk a little bit more about facts and figures, right?
No, we talk heaps of shit. Yeah, heaps of shit. Yeah, it's the best. It's like
we don't allow swearing on this podcast, by the way.
Oh, sorry, mate.
Because we have a lot of parents listen to this with their children in the car.
Okay.
Yeah.
Okay. Well, sorry about that, guys.
No, we can beat that. It's okay. But it's cool the fact that
I love it, mate. It's a good bit of fun.
You're buying more houses than units.
I don't buy units unless I'm buying the block.
Unless you're buying the block.
Yes.
How many blocks are you buying these days?
We still
Is there much around?
Yeah, it's hard to get good deals.
Yeah.
Like when you go, because a lot of the time you're buying your blocks in regionals. Unit blocks like 2, 3, 4 years ago, I could quite consistently get them at 9, 10, 12% yields.
Yeah.
It's very hard to get even above like 8% these days.
Okay.
But yeah, we still probably buy one a month with a 8% plus yields on them, and they're good, man. They're good. I like them.
And how sort of big? Sort of 6, 7?
Nah, I normally try and keep it to resi. So I normally try and keep it. I'll go between like a duplex, triplex, 4-pack.
Yeah.
That all stays in resi funding.
That's a really good point. Can you explain that?
Yeah.
To our listeners, because the people they go, oh, I could buy a whole
Yeah.
apartment block, but the lending is different.
Yeah, definitely.
Yeah.
So obviously you go into commercial lending when you go over 5 generally. 5 and above is always commercial. Some lenders are at 4, they're commercial, but most of the time you can stick it.
Unless they're strata, then you can get resi on individuals.
On individual, yeah, but you kind of want to, if you're buying them for cash flow, and if you, like a lot of the time the upside is really when you're buying them all in one line, and you can do that to them as well, like a bit of a future play down the track, give them a renovate, individually title them and flick them off.
Yeah.
So I normally don't like buying them when they've already been individually strated. But yeah, when you go, a lot of the time it's up to 4. So your duplex, your triplex, and your 4-packs, they normally stick with resi funding, which is literally like the same as what you can normally get an investment property for, in terms of rates and LVRs and all the rest of it. As soon as you go to the 5 and above, then you start playing in the commercial territory. So it can be 70, 80% LVRs. Normally you throw a percentage point onto your interest rate as well, so a lot more expensive to hold. Yeah, man, I'm not normally the biggest fan of going over that. I've got 1 5-pack in the portfolio, but I typically like to stick to 4 and under.
4 and under. Okay.
2s and 4s can be really good because 2, 3, 4s you can normally get really high yields on them. Yeah, and there's a lot of the upside on those lower ends, and yeah, good rates, good LVRs. They're good.
Yes or no? There's less property investors in the market today than what there was a year ago.
Yeah. Yes. It's still active.
Yeah.
It's still active. Quite active. It's super selective. So there's probably 95% of markets out there right now aren't worth buying in. You're better off to sit and wait and see what's kind of happening with them.
95%.
There is a huge amount of markets. Yeah, I'd say at least 90% of markets I personally wouldn't be touching.
Okay.
And the pure fact of it is, affordability is shot, and a lot of the affordability hasn't actually properly come through and come into effect yet. A lot of people have called the market the bottom of the market in a lot of these areas. It's like, yeah, cool, bottom of the market, and the fixed rates haven't even come off yet. Like the affordability factor doesn't actually come in until they do. So there's a lot of markets there that we wouldn't touch purely for that factor, because as soon as that comes into play, the affordability goes through the floor. It works in a balance like that. So as affordability goes down, as that unaffordable rate goes up, that affordability of the property goes down, and typically your pricing goes down with it as well.
Yeah. And have you seen, yes or no, investors have a lot less serviceability today than what they did a year ago?
Yeah, definitely. Yeah.
How much, like, imagine there's a lot of still strong investors out there who they're cool at the moment. They've got the cash flow to push through. Holding costs have changed, operating costs have changed, but does that mean property as an asset class has changed in its inherent value?
Man, I think you just got to be more strategic. So like people starting out now, I think you got to have a very strategic game plan. You can't think you're going to leverage yourself to the moon and do it in one hit. It's not going to happen. I almost, these days with new guys coming in, we kind of build their portfolios till we hit ceilings. I want to hit ceilings because you want to hit the ceilings with multiple properties, but put them in good, strong growth markets. Write them, then you might have to park yourself on the sidelines for, let's say you do 3 deals over a 2-year window. The deal you bought at the very start, it's probably only got, if you bought in the right market, probably only got 1-2 years max left in it before that peaks out. But when you sell it and you cash out, that's when you can be quite strategic. And this is where, like, a lot of my guys that maybe their serviceability is capped now and they were 3-4 properties in, but they can sell it down, get the debt back, roll into trust with $200,000-$300,000 worth of profit, and then all of a sudden they've got all this new borrowing capacity in trust, and they've got this large chunk of capital they can go inject into it at 80% lens, and then they can start scaling in there. So I think that's where and I know we're about to dive into this with my own stuff, but like with what I've learnt with all this, I built a large portfolio on a very low income. This is all the stuff I learnt. Like there's times where you have to take a step back, get your debt back, get your borrowing back, and get that big chunk of capital back, and then redeploy it somewhere else, and just leverage it in a more strategic and a more intelligent way to be able to keep going.
So shuffling the decks.
That's it, man.
Constantly.
Yeah.
And are you seeing a lot of cash up investors right now who are they've done that and they're waiting to strike, or as soon as they've got some liquid assets, they want to spend it straight away?
It's a bit of a mix. Most of my guys, I seem to attract a more aggressive style of investor. So a lot of my guys are very happy to be, selling and redeploying and getting back into different markets. But I am seeing, and I've heard of a lot of people kind of sitting on the sidelines. Man, I saw it happen in COVID as well. I distinctly remember a couple of phone calls after went up on the news and a current affair or whatever it was, about 30 to 40% drops were coming. And I remember people sitting there with cash going, mate, if you can get me a 30, 40% discount, I'll buy something.
Buy it.
It's like, yeah, man, no worries.
You didn't see any?
No. We saw some big ones. I got some in the 20% plus discounts during COVID. So there were some big ones, but there was never that level.
Why were they coming off 20?
Okay, so during COVID, what happened, and mate, if you go back, we did a podcast right at the start of COVID. It was like April 2020. I remember it because it was big to come out and say this. And I remember saying, the way I saw it going to happen was everyone that needs to sell is going to sell at a discount, right? They're just going to get out. They're going to be scared. They're going to get out. They're just going to cut their losses and move on. The people who don't need to sell are going to pull their properties off the market. And then all of a sudden it's going to go into this there's no stock, right? And when there's no stock, anything that's there, the people who do want to buy will start. And that's where it will start its run. And that's essentially effectively what happened. So the people who didn't need to sell didn't. The people who did need to sell took a big haircut because there weren't that many people around. And that's where we're getting some really, really good discounts. And there is a little bit of that, like not so much like the big discount side of things now, like huge discounts, but there's stressed sellers starting to come to the market now. So there are some really good opportunities around.
And yes or no, is that sort of people getting ready for, well, obviously rising rates, but this interest rate cliff, right? That's going to accelerate, do you think, a lot of distressed sales?
It will.
And if it does, how long will that moment be of distressed selling?
It's going to be an interesting one to watch because obviously different rates are going to come off at different times. So it'll kind of be like that slow, probably a bit of an avalanche sort of picking up pace, snowball sort of style effect, right? So it will take time to really pick up. But I think what will happen, it always happens, is people over leverage themselves on their primary residences and whatnot. If they don't have other properties, they're going to struggle, and there's going to be issues in that end. A lot of the time, it's in the top end, the middle to top end of town, where people really go big. But what they typically do is they sell the things that they don't need. So if they don't need an investment and they need to like cash out of something quickly for some cash on their own home, or holiday homes and things like that, And that's where there's a bit of opportunity, because a lot of those markets, there's actually still a lot of heat in those markets, like affordable investment grade markets right now. There's quite a lot of heat in them because there's only a small percentage that still make the cut. But it's and if you've got the right connections, it's getting those guys in other markets that are stressed and they need to sell quickly, and they're not going to market. They're selling them quick and easy off market, just taking a haircut, getting rid of these things quickly. And that's where there's actually a fair bit of opportunity starting. It's already starting. And I reckon, by the end of this year, it's going to be in some pretty decent flow.
Okay. And you'll be there waiting.
I'm already there waiting.
Where's that?
Sitting here a little.
Yeah.
Where's that?
Where are you going to be waiting?
I'm in the SBI headquarters right now, mate.
All right. Well, to actually work out where Sam's buying, you're going to have to give him a call. It's probably the best way.
Probably the best way, yeah.
Yeah. People call you up, sort of digress a bit. They go, I'm thinking about buying a property. Where should I buy, Sam?
No.
People don't say that.
No.
No.
The only people who have my numbers are like genuine clients, so you can't call me up and say that anyway.
But do clients ask you where they should be buying?
When we do strategy sessions and when we start like planning things out,
Yeah.
we talk about it all then, and we essentially talk through the options and where people are comfortable with, where the pros and cons are, where risk versus return on.
So do you buy a sort of hyper condensed where you'll just choose a handful of places and just go bigger than move on?
Yes.
Okay.
Yeah. So we become.
Do you have a name for that? Did you call it anything? It's like
I just call it being an area expert.
Yeah.
So we typically we have multiple buyers agents on the ground within Australian Property Scout, and I always ran it exactly the same way for myself. So I would hone in on one or two councils, and that's it. You might be buying in 8 to 10 suburbs, and that's it. But like you're an absolute expert. You know everything that's coming up. You know every single agent. So as soon as someone calls you with a deal, you know what's a cracker and what's market value, and you know what you're passing on and what you're buying. And I think that real area expert analysis, ability to analyze deals that quickly and that strongly, like that's, in my opinion, that's what sets us apart.
So one or two councils, so one council area might have 4 suburbs that you're buying within in that area.
Yeah.
And it's normally in areas where other buyers agents aren't yet operating. Like, do you sort of get that uniqueness? Like, when do you know it's time to get out? When other buyers agents arrive?
Yeah, well, I call it when the dumb money comes in. So when you get the dumb money, like especially high volume buyers agents that just come in and they're just smashing everything on market, paying overs. We actually have a bit of it's a gripe of mine where like then they start to get preference. Sometimes they'll start getting preference over agents off market. We always
because they know they're going to higher price.
Higher price and yeah, man, and you find a lot of the time the people you see like advertising heavily on like Facebook and Instagram all the time, they're high volume buyers agents, and a lot of the time they're just clicking and flicking and they're just burning as many deals as they can because they're paying high volume to get these people and just selling deals quickly like that. So a lot of the time, like when that starts to happen, we'll start to kind of taper out. But we always have really good connections. I actually, mate, I laugh at this because there's a lot of people that call themselves like the data experts, and they get in there 6 to 12 months. They make these claims. They get in. We've been in there 6 to 12 months before they're there, and if anything, they're the ones that give our clients the big boost up in values because the dumb money comes in. You know. So,
yes or no? It's more important to know when to stop buying in an area rather than when to start buying in an area based on that logic. So, like, if you miss time getting in by a couple of months, it's better. If you miss time getting out, it's probably more impactful because then you sort of start buying, to your point, when there's more dumb money coming in. So, from getting in, it's a really good question. From getting in to getting out, what sort of price differential? What sort of price differentials do you want to see?
So
if you first get into a market at 400, do you get out when it's 400 still? Do you know what I mean? Because then start pushing up.
I get you. So I made this mistake in Sydney, and it's something I've learned a big lesson from, because in Sydney I pulled out when a market did 10%. When the market first did 10%. The issue with that is if you're buying in at the absolute bottom, especially if you can get a discount, a lot of the time, like, and I'd witnessed this in my own portfolio, like a market can do 120% if you're buying at the absolute bottom, especially if the market's dead flat. So what I typically find is, like, let's say that there's the 400 grand mark, right? And let's say you average 5 to 10% discounts below that when you first enter because the market's dead, no one else is there, you're cleaning up. Normally from that 400, so let's say we're buying somewhere around like a 360, 380, 370, something around that. But 400 is kind of that base mark. Normally when it gets to, I'll normally go these days until about 30% of growth, purely because at that point, we also know the market's having a significant upcycle. And so when it's having a significant upcycle and then we start to witness a dumb money, which is normally what happens, they see it somewhere, this market just did 20% growth last year, let's pile in. we normally still have the connection. So even when it hits 30, maybe 40% in terms of median growth, we've still got really good established connections there. So we might still be buying at 10% below what that is at that end. And so that's normally where we're kind of pulling out when that dumb money starts to come in, which is normally around that 30%.
What happens if the dumb money doesn't come in? And to that point, if you get in at your identify location, you get 30%. You're going to go, that's a pretty good job, right?
Yeah.
So that's the sort of the first tranche of growth.
Yes.
Then ideally, you want to be viewing on the basis of whether or not that dumb money will come in and give you that next tranche, right? If you get the first tranche, it's okay, but you want to double down on 2 tranches.
Can I guarantee? There's you know how there's those guarantees in life. You got the tax, you got the death, and then you got the dumb money.
Yeah,
that's always going to come in.
Do you reckon you always get dumb money,
mate? They see the growth. Just did 20%, just did 30%, whatever. Or let's just did 20%, per annum over an 18-month window, 24-month window, whatever. Mate, that always comes in without fail. They're what drives the market.
And do you reckon a lot of that is non-buyer's agent originated business? Do you reckon it's just because you've got to remember, like, I don't know the numbers, I can't find out.
Yeah.
It's like buyer's agents, by and large, pretty shrewd and savvy, right? But most investment properties are still bought without a buyer's agent.
Yeah.
So what I think a lot of people do, they're armchair investors where they listen to the buyer's agent. When they start talking about something, is when the non-buyer's agent or property strategist originated investors start getting in because they buy into the rhetoric, right? Is the dumb money and is that dumb money? It's a bad term.
But I'm a blunt person, so I call it out.
It's your turn, not my turn. When that starts coming in, and it's not necessarily always buyers agents in there.
Yeah, of course.
It's probably the heavy lifting is probably done by non-buyers agent originated people who are sort of investing off social media.
Mate, you and investing off growth charts. Places saw, it's had growth, it'll keep going. I agree with you 100%. I think you'll get a portion of. And by the way, there are other, obviously, there's other good buyers agents out there. I'm not calling all of them dumb at all. On that end, so I'm always the first to admit that. But yeah, man, you'll get a very small portion. A lot of time, it is only us at the very start. You'll buy through. Market will start to run. We normally have still got a fair bit of time because there's always lag data there, so it doesn't actually go out on that end. Then sometimes you'll get some of the, you get you almost like your dumb money BAs sort of coming in on that end, and then you'll get your masses because then it'll come out in a report and everyone starts talking about it, and then 100%. And what happens then at that point is there's 2 forms of dumb money. And by the way, like again, I apologize for coining that term but it is a realistic thing. And dumb money a lot of time can be first-time investors where they don't understand the market. And it's a bad expression, but it's realistic. They're uneducated people. It's the same as first-time investors, first-time buyers for their own homes. They're the ones that a lot of time, they'll pay more than each other because they're trying to secure the asset. They keep missing out. So then they end up paying more. That's what sets new precedences. That's why markets don't do, there's an age-old thing, every 7 to 10 years property doubles. It doesn't happen in like a flat line. And realistically, it's more like, 10 to 14. It doesn't happen in a flat line. You might flatline for 10 years and then double in 3 or 4 because it goes like that. It has the big, that FOMO comes in and everyone's trying to pay overs at the back end of the market. It could be for a year, 2 years that everyone's paying overs in that sense. And that's what really drives a market to do stupid things at the back end of it, especially like a final, let's say is 100% growth in a cycle. The final 50% is normally that. It could be your first home buyers or emotional home buyers against the investors at that point. And that's what can really, really drive a market. And that's where people get burnt.
Yeah, and it's really, there's lots of ways you can pull this out. Like, the dumb money, it's a bit of a base term, your term.
I'm from the bush,
mate. That's okay. But the point is, you don't want to be the person deploying dumb money.
Yes.
And that's what you want to try and avoid as a property investor. Hence the reason why a lot of people listen to this. They want to be a smart property investor, right? So what are the 3 telltale signs that dumb money has arrived?
When you're seeing things getting listed like for a fair market price and they're selling 10% over and they're selling straight away and there's 20 offers on the table.
Okay, so that's point number 1.
Normally that's the biggest one.
I'd probably say I'd probably add a point to that. Another signal that the dumb money's arrived. If you're a buyer's agent or a shrewd investor, agents stop returning your calls.
Yeah, it's a big one. I don't have too much of that, so I can't really relate. Probably could have back in the day, but that would be 100% one as well.
Yeah.
When you start seeing it mainstream, So you start seeing it in forums, and you start seeing
So
it.
that's your third point. When you start seeing people talking about it,
you're too late.
The dumb money's arrived.
You're too late.
There you go.
Unless the only caveat on that is if it's at the very start of people talking about it, and like I was saying, like if it was a very
bit to go.
Yeah, and if it's at the start or even in the first like some whispers, and then it starts being spoken about. But if you're getting a discount and you're buying it like 12 month ago pricing, and there's still a good run left in the market, there is always still opportunity in that sense. But when it's been talked about for 12, 18, 24 months and the market's still running, it's be very, very wary.
So in many ways, it's a cycle of 3, right? So if you're in there early,
yes,
you can get stuff at discounts.
Yep.
So fair market price is X, you should be able to negotiate a cheaper price.
Yep.
You get the uplift on that to fair market, and then you've got the inherent growth that the property should give you because you've identified it as a good place from fair market price to the organic growth that it's provided. And then that third cycle, third tranche is when, to your point, the dumb money arrives, gives another uplift.
Yeah. And that can run for a few years.
Yeah.
Like you look at Sydney, let's say in Sydney 2013, 2014, obviously if you bought before 2013, that's when you could make maybe like 2011, 12, 13, you could have made some really good
Great
buys.
times to buy in Sydney.
100%.
Yeah.
But then like 2013, 2014 was probably still okay to buy. You probably still, like that's when I pulled out. I pulled out late 20, or probably early 2014.
I got out then, I started buying in Brizzy.
Yeah, there you go. And so like...
And sat around for ages waiting for growth.
Yes. You probably could have still bought 2014 and done well. Because 15, 16, 17 was when it went really crazy. So if you still bought 2013, 14 when it had started, you still would have had 2 to 3 years of really good run. But if you'd started buying 2015, you're really cutting it fine. 2016, 2017, by 2018, 2019, you probably actually were worth less than what it was in 16, 17.
Right.
So
well, there you go.
There you go.
Got something out of you. Something out of him. Yeah. It's good enough. Very informative. It's a good way to think about it. Maybe we've got a time. We'll come up with a better term.
Yes. Okay.
Yeah, because it's.
I'll have a think.
But you know what? Like, you don't want to be too precious about it, but it's about being a smart property investor. What's the opposite of being a smart property investor? You're a dumb property investor.
I was going to say it before when you said you're on the smart property investor. I'm like, this, mate, it's people are listening to the show to educate themselves. We're not talking about it. People are listening to the show.
We want smart, not the dumb people.
That's it.
Anyway, maybe I'm okay with it. Sam, 31 properties by 31.
Yes.
We spoke about that, I think, in January or February of last year.
I think it was Feb,
2022.
That's it.
1 year on.
Yep.
March 23.
Yes.
So you did 31 by 31?
I did.
I think you did 32 by 31 by memory or something like that. Or you sold something. I'm trying to remember. Where.
No, because I wanted to hit the 30 by 30, but
That's right.
I had the build going through and it capped my borrowing.
You changed your narrative.
I changed it.
So what's the next one then? What's the next goal? What's the next? And by the way, it's a nice goal and it's nice to put a bit of iteration stuff to it, but what's next for Sam Gordon?
So 31 by 31 was something I chased, like same properties as age. I kind of wanted it ever since I was, I don't know, early 20s probably. I really wanted to hit 30 by 30 was really always in my mind. Missed it, went for the 31 by 31. And I remember when we caught up and talked about this last year, I wasn't really planning on acquiring. I definitely didn't have it in my scope to probably be acquiring last year. I had a lot of renovations, I had a lot of builds I wanted to do in the portfolio that I kind of had on the go. So that was kind of more my focus. So, mate, I honestly actually didn't have a goal for that next sort of phase. I was kind of thinking maybe 50 by 35 or something like that, but I hadn't really set anything in stone.
So you don't have anything?
I didn't have anything. Oh, you mean where am I at now?
So you didn't have anything, but now you got something.
But now I got something.
What is it?
So it
better be a good catchy headline, because I know you're a competitive guy, and you would hate the idea that this podcast that we're recording right now isn't the most popular podcast for 2023.
I definitely wanted to hit number one again.
Give me something good,
mate. So I ended up hitting 40 by 32.
Okay. So you're going to add 9 properties in 12 months.
Yeah, I ended up adding 10, but I sold one as well last year.
Okay.
Yeah.
Mate, do you need 40 properties?
Probably not.
It's a headache, hey? It sounds horrible. It's a first world problem. You don't need 40 properties.
Okay, so I've got a different way of managing it because, and there's two things, like, it's almost like surplus deals through the business. Like, things come through that are like really hairy deals that, like, is a little bit too much to give to clients. I was talking to you and Jim off air about the termite-ridden joint. There was just a knockdown, and it was just, we tried to work it for a reno. It didn't work for a reno. Ended up dozering it, splitting it, all the rest of it. Like, there's just deals that come into the business that are just like a bit too hairy for clients. Yeah. But I've dealt with all of it before. Yeah. So it's just like when those things sort of come in, but you just, mate, I just ended up acquiring. And in terms of headaches, mate, I don't find it a headache because what I do is, I like to cluster. So I'll cluster. I believe strongly in areas when I start acquiring in them. I will always buy in an area before I put a client in there, just to like run the process, get the property managers, get the building inspectors, like get people we can trust working with and stuff as well. So I'll enter an area early and then start knock a couple of renos over to make sure we've got the teams. And man, like it's just like, so I'll end up clustering areas. So like in Brizzy, I have about 15 properties, about 25. So it's 40 properties. I've got about 55 rentals with extra dwellings and stuff. I've got about 15 properties, about 25 rentals in Brizzy. I've got 2 property managers for the whole portfolio there. In Sydney, I've got 1 property manager for like 6. In South Australia, I've got one area that I've got 9, another area I've got 4 in, 2 different property managers for that. And it's, you know what I mean? Like it's just a cluster property manager. So you think it would be a headache, but you work with really sharp operators, and you are super valuable to their business because of what you've got in their portfolio. And this is actually what our clients get to leverage off, because it's not like they're going in, they got 1 or 2 properties with these guys. They've got my whole portfolio, and then they've got all our clients' portfolios as well. So like it's like they're in this system and this, you know what I mean? Like they're all part of it. And that's what, man, I just find clustering, it's the easiest way to manage a big portfolio.
So that's the management side, but on the acquisition side, you need to buy property a month, pretty much. Is that right? What are we saying? 40 by 32.
Yeah. So it was 10 properties in about 11 months.
So how do you find the time, like, to do it? I guess your day job is finding properties. How many of your clients say, "Oh, Sam, I want one of these really hairy properties"?
I get a couple. I've got a couple of guys on the books that are happy to take it on. Yeah.
The fortune favours the brave.
Yeah.
You go, all right, you up for it?
Yeah.
Like, you know, risk reward, right?
Yeah, 100%.
Like, this is where it can all go wrong.
Yeah. Yeah, I mean, this
can go wrong.
Yeah, this is all part of it. But like, it's one of those things where like those style of deals, I don't always have someone on the books for. And that's, man, if there's a client on the books, and I'll run it by them first. If they want it, of course, I'll always give it to them. But yeah, mate, it's 100% that. It's risk versus reward. The one that I did that I mentioned before was like termite ridden. I wouldn't have put it onto a client because it was like, the numbers were super juicy with the reno, and then it was reno, you could strata subdivide a block off because it was an 800 square meter corner block. That's where the numbers were super juicy, and they were really good, but it was just like, we knew it was pretty bad. Yeah. And by the time we stripped it all back, which we couldn't do until we bought it, we stripped it all back, and then we just realized, man, this thing's shot. But it was cool because in like the 12 months it took us to kind of get through all the planning side and work out exactly what we're going to do with it. The council changed the planning laws, and then we're able to subdivide the 800 square meter corner block anyway.
Happy
so
days.
It came out winning anyway,
yeah.
man. So.
Okay, so what did you pay for that place?
Mate, I bought it like well below land value. So land value was it was a distressed sale. I bought 2 side by side, and the one on the right was pretty good, not the corner block, and the other one was a complete dog box. I ended up paying $250 for it. It was probably worth about. This would have been. Well, yeah, this was right probably after we chatted last year. So about 12 months ago. It was right when things started getting a bit hectic with interest rates, and this guy just needed to cut them because he had a development that he was stressed about.
So it's 2 blocks. So like
so the block on the right I paid $310 for.
Yeah.
And then the block on the left, like the corner block with the shot house, that was $250.
So you're going to split that, are you? So
I'm splitting the corner block, keeping the other one.
Okay, so have three properties on 3 different titles.
Yeah. The one on the right, I'll dual lock that. I'll build a secondary dwelling. But the one on the left, now I'm just going to chop it. I'll build 2, and I'll probably just sell them.
And the same owner.
Same owner.
Yeah. Where is it? In Brisbane?
Brisbane, yeah.
Okay. I won't ask you where it is because you probably won't tell me, will you? Or you're out of that market now. So that's a lot of energy and effort that's got to go into that, right?
It comes down to having a team, but like we got the team. And this is what we do for clients. So like I got a project manager in house these days as well.
What do renos and
builds? Yeah. And I got a really really good construction team. So it's the same thing. Like my clients use the same team, same project manager, same builders, same reno crews, everything that I use for my own portfolio.
Yeah.
Man, you give them a brief, they go off, they get all the quotes, comes back. If there's things you want to change, you change it. If not, it's all good. Like, mate, I work a fair bit, and I put time into this on the side, sort of thing, and it just is what it is. It's part of the wealth creation.
You're still picking up a tool and getting stuck in?
I haven't for a while.
No.
I haven't for a while. But most of my renos aren't close to home. Yeah. So like I always did it when they were like, when I used to do my own. I used to do 10, 15 hour drives to go do them, but that was when I was.
I remember. Tell me about that.
Yeah. Different times, man. Different times. You got to look at the opportunity cost of even just time off.
I always struggle with that because I can do that, and you start doing it, and you just go, I really shouldn't be doing this. Even though it's enjoyable. But, It's good to keep your hands a bit in.
Yeah,
you know,
yeah, definitely. And I think like you can always stay on top of it as well in terms of trade prices and everything. But man, I guess coming back to the portfolio, like it's all a snowball, right? So like it probably seems crazy to most people to think about buying 10 properties and selling one. That's 11 transactions in a year.
Yeah.
To me, man, it's literally just on autopilot. Like I don't even think about it. It's just normal.
Just what you do.
And this is where like I have strategy sessions with clients, and we're talking about the different lending scenarios of what you can do. You know, selling your personal name, going to trust, build it like that. And you know, I was having a strategy session with a client the other day, and we're running through what we can do with him. And I kind of said it like a bit, almost a little disappointed for him that we were selling one, putting into trust and building that, and that we were going to be able to do 2 a year, but then we do 2, and then you're going to have to wait to 12 months for different lending purposes at the time, and then strip the capital back out of them, and then roll into a second trust and do it again. And I thought he'd be like, I personally thought he'd be a little bit disappointed. He was like, man, I can do 2 a year? I was like, yeah, well, with the borrowing at the moment, the way we can do it, you definitely can. And then there's no reason why in 12 months, you know, we know we're going to make good margin. We're in the right market. You'll be able to pull it back out and roll again. He's like, 2 a year. And I'm like, yeah. And so he's already on, he went to 4.
He's got the bug.
And he's like, fuck, so in like 4 years, because of what he already has, I'm going to be over 10 properties. I was like, yeah. And he goes, he's ecstatic. And then it makes me think back to when I was like 25, 26, and I was buying like 2, 3 a year. And but it just starts to snowball because you go 2, 3 a year. Then it turns into like 3, 4 a year. And then it goes 6. And then all of a sudden you're doing 8. And then all of a sudden you're doing 10 in a year. And it's
and it just normalized.
Yeah. And the portfolio snowballs. And that's why you ask about being a headache. And it's like, it's on autopilot, you know, like I'll once a week, I'll check like what I have in my personal, like on my portfolio emails, and I'll get back to everything it needs to get back to.
Yeah.
I just do it. It's just like a business. It's like things that are worth doing, I do them. Things that aren't, no, I'm not doing that. And it's just, that's what it is. You know what I mean? I don't overthink any of this stuff.
And that's the difference between being a more sophisticated, smart investor rather than a dumb. And a dumb investor isn't just putting money in the markets where they've missed it. It's a lot of it's down to management and structure and all that sort of stuff as well, right? Like 40 properties by 32.
Yes.
So 9 properties more before you hit your 32nd birthday.
Yes.
How are you holding all these assets? In trusts, personal names? It's complicated. Your tax structure must be getting a lot more complicated. How are you finding that?
It's not too bad.
Be careful what you wish for. Yeah.
It is a bit, but what I do is I'll go set up like 2 or 3 trusts at a time, and then I can, all the paperwork comes through at the same time. It's kind of, everything I do is like clustering, right? I do everything in a hit. And then even in terms of like buying, like I'll pair up different states within different trusts because it gives me different land tax thresholds that I can isolate.
Yep.
And you kind of, again, you're clustering, even though you're clustering like different states, but you're clustering it all within one trust. And even, you might set up 3 trusts at once. Go set up 3 bank accounts at once. It's all in like one appointment, and then I'll go get 6 pre-approvals just to have them sitting there. It's just like one set of docs, you know what I mean? That I'll do at one time. So yeah, man, it's fine. In terms of structures and whatnot that I do, like obviously when I started, which I do recommend is you know, you
personal
might
name.
go personal name, build it out in the personal name first. I've sold some of those off, which is fine. Most of the stuff in my personal name will be sold off, you know, over time as well, and then the rest is pretty well all company trust structures and just really build it out within that.
You've got a good accountant, obviously, Sam accountant.
Very savvy accountant.
Know what they're doing.
Yeah, man, he's got like a 50 property portfolio himself.
Okay.
So
yeah, it's a good operator.
Yeah.
Okay. And how you going with lending at the moment?
Sweet.
Okay.
Yeah, sweet.
What sort of spread of lenders do you got?
I just went through, so last year I went through a massive refi with CBA because they kind of changed a lot of the lending policies. Cash flows are huge on the portfolio as well because I had a lot of, like I said, 40 properties, like 55 odd rentals. Very highly positive cash flow, the portfolio. So I was able to go through and actually refi a lot of what I bought during COVID. This is actually where I made some ridiculous gains. I was super aggressive in COVID with low doc lending. I just went pedal to the metal and just thought I'm just going to run with this thing, and acquired really heavily. But it was all low doc lending. Everyone was getting their loans in the 2s, and I was paying 5%. But the difference was minimal in terms of cash flow. But I was making 50 grand away into a deal, and now it's gone up by 300,000. So it was super worthwhile. And I just went through and refired a shitload of that back out with CBA. And then again, last year, a lot of the stuff that was even with second tier lenders, not low docs, but second and third tier lenders, going through a big refi with ANZ. So it's just like
back to the sort of major banks.
Yeah. And a lot of time you can do that. I sold an asset that I had a lot of cash in, but also had a lot of debt in. So I was able to reduce a lot of debt and LVRs on that. There was a low yielding deal that had performed exceptionally well. So I just think like being intelligent with the portfolio like that, knowing when there's times to sell things, there's times to hold things, but there's also time to sell things as well. And I'm a big believer in that. I'm never someone that will advocate, buy, never sell, because it's super relevant to a portfolio and to an individual investor.
Yeah.
And so, yeah, man, just kind of restructured the debt and restructured my own positions.
So do you disclose now the value of your portfolio? You don't talk about that anymore?
I've always talked to you about it, mate.
What is it?
I'm a little over 20. I'm just shy of, after selling the big bopper that I had, I'm just shy of 21 mil.
21. And debt?
Just under 10, so I'm about 9. Oh, with this big refi, I'm about 9.5 mil.
Okay, so you're about 50%.
Yeah.
LVR.
Yeah.
It's all right.
Yeah.
$10 million, 10 and a bit.
Yep.
Yeah, it's not bad going.
Yeah, the yield overall in the portfolio. The crazy thing as well, the last couple of years, like everyone's talked about all these rent, and it's very true. The interest rate rises, have been immense. Have been really big. But I think what's really cool is the amount of rental growth that we've had.
Yeah.
So many of my houses that were renting for $350 a week are now at $500 a week.
Yeah, it's changed a lot.
Huge amount. You would have experienced it. It's very similar markets that I know that you and I are both in.
Yeah.
Man, there's been some ridiculous rents. Like some of my properties down in Sydney were at $550, $600. Now they're at $850, $900. Like huge rental gains. So yeah, like a lot of my portfolio was acquired, even bread and butters, which are like growth properties. They were acquired at 6-7%. They're higher than that. A lot of my cash flow deals were 8-9%. So they're now in the double digits, well into the double digits.
So what's the positive cash flow in your portfolio at the moment?
That is something I haven't worked that out properly because we've had all the rises. I'm going through refi. I've still got a bunch of fixed.
So rent's gone up, but cost to operate's gone up.
That's
so,
it.
Yeah.
That's it. So
I'm trying to work it out myself.
yeah, there's a lot. There's a lot.
Yeah, it's tough, mate. Cool.
Thanks, mate. It's good fun.
Yeah,
I love it. I hope you enjoyed it, mate. I hope the guys, the listeners enjoyed it again. I know last year's went off. Hopefully people enjoyed this year's as well.
40 by 32.
That's the one.
All right. There you go. 4032. Which postcode is that?
I don't know.
Buy somewhere there because it'll be good for you. Somewhere in Queensland, right?
Probably. Yeah, it would be.
4032. That's how you should be investing, just on new numbers, smart numbers, right? Isn't that what you do?
Writing down numbers.
4032. That's where I should invest in property.
I don't think you should.
I tell you, a lot of people do that.
Smart property investment. I don't know if that's your show anymore.
4032. All right. There you go. Well, maybe it might be number one. Let's see.
Let's see.
40 by 32, but we covered a lot of there at the front of the podcast, mate.
Yeah, no, it was good, mate. I enjoyed it running through that stuff.
We'll see you a bit this year as well. Come back, update us. If there's anything you want us to talk to Sam about, let us know. You can email the team editor at smartpropertyinvestment.com.au, but I'm sure we can find up some pretty cool, have a chat about later in the year, mate.
100%. Thanks, Phil, mate. Appreciate it. Always jumping on.
Cool, mate. And you're all over the joint. People can just Google you and find you, right? It's probably the easiest way.
Go to www.australianpropertyscout.com.au. It's on all the socials. If you want to give us a little bit of love over at the podcast, listen to me talk a bit of shit. The Scouting Australia podcast. If you don't mind, Phil, mate.
Mate, that's all right. There'll be 10 other people listening to it. Yeah.
That's it. I'll steal your whole audience of 10 people.
Take the whole audience of 10 people. So that's right. No, I've listened to it. It's good.
Oh, you like it?
It's all right.
Oh, it's all right.
It's okay. Yeah. Keep practicing. You'll get better.
Mate. Thanks, mate.
No, it's good. It's good to see. And I think just compared to even a decade ago, the proliferation of information around property investment. Hopefully, more people are going to be smart property investors. But I think the inverse actually applies, where there's so much out there right now, it just stifles people's ability to get stuff done. So don't.
I think that's what I like about the difference of ours is it's my strategy. So like, I'm hoping people listen to it, like want to follow our strategy and my strategy of how I've done things. I think sometimes it can be information overload with a lot of different things. And that's what I kind of like about it, I guess, being able to, you and I always jump on and we talk the way that I invest, but I just kind of, put out the message and just kind of how I do things.
Well, you need to do it right because, your particular way of investing, your strategy will work for some people, might not work for others.
100%.
They might go, I don't want to be doing that. Or to your point, you're probably more on the aggressive side, but you're only 31 and a bit years old, right? Most people haven't started investing yet.
Yeah.
You're already sort of, got the advantage of a couple of market cycles there, right? So there will be a point in time where you'll become a bit more conservative, right? And that's just natural.
Yeah.
That's okay.
Yeah.
That's cool. But make hay while you can. Absolutely. You can do it in a way in which is measured and de-risked as much as possible.
Yeah.
Why not? And that will resonate with some people, right? So
definitely.
Cool.
No, I'm with you, mate.
All right. Sam Gordon, remember to go and check out smartpropertyinvestment.com.au. social media, Smart Property HQ is where you'll find us. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.